Hi, welcome back to the channel. In this video, we will be looking at topic 1.2, which is again another subtopic of global interdependence. Okay, now in this topic 1.2, we will be looking at the patterns and the trends in the global trade. In other words, we will actually be looking at how trade in the world has evolved over years. Okay, now so we will be looking at factors that causes the change in the global trade. Okay, which means we'll be looking at factors that actually affect economic transactions. In this case, our focus will be on factors that actually affect exports, to uh, a change in exports, a change in import, a change in capital flow, or we call it foreign investment flow, and a change in the return on investment. Basically, those are the things that we will be looking at generally, okay? And we say factors affecting economy transaction between different economies would be between countries. In our syllabus, we will have another topic, topic 3, that talks about patterns of Australian trade. Australians patterns of trade. So that is focusing on Australians export and import. But in this subtopic here, it's focusing on the world perspective. Okay, between economies, transaction between economies. Okay, so that will be the main part of this topic. Then we will cover a little bit on the composition of global trade. Okay, just very little. Okay, let's start with the factors affecting economic transactions. Okay, you would realize as we go through this video, you would realize that I do not put in the facts, okay, for this subtopic. Reason being, this subtopic is not a very significant or a popular questions that they would ask in WAIS exam, okay? And even if they were to ask, you don't really need to remember the subtopic as a separate thing. As you go on with the syllabus, you will realize that this subtopic becomes a general idea. Okay, so you can use facts and example for the later topics, okay, and put it in here. That's why I don't want to put another set of facts for you to remember, and that would increase your burden for no reasons. Okay, so factors number 1 is the exchange rate. So what is exchange rate? It actually represents the value of one currency against another currency. Okay, so for example, 1 Australian dollar equals to how much USD? Let's assume Australian dollar appreciate. Okay, APP here means appreciate. Let's assume Australian dollar appreciate. So when Australian dollar appreciate, of course, price of Australian exports will be higher in terms of foreign currencies. Okay, in terms of foreign currency. Okay, now because of that, then generally demand for Australian exports will be lower, because your trading partners, your customers, your foreign customers, overseas customers, they would have varieties to choose from. They can choose to buy from other country. Okay, so generally for products that doesn't have much for product that has many choices, okay, consumers may choose to buy from a cheaper source. Okay, so if your price is higher, then demand for your export will be lower, and that will cause your export revenue to be lower. Okay, you will earn lesser, okay, and therefore your trade balance will surely be lower, because trade balance is export minus import. So if your export is lower, then of course your trade balance generally will be lower. Okay, next, if our currency were to appreciate, then of course price of import would be lower in terms of our currencies. in this case in terms of AUD, okay, in terms of our currency. So if that is the case, then of course if we can afford, we will be buying more import. Okay, again, if we were to buy more import, it will still same thing, contributes to lower trade balance. Okay, and lower trade balance, okay, would actually cause our GDP to go down. Okay, but we don't really need that. For this particular subtopic, we only need to end here. Okay, or even you end here, it's fine. You don't have to end at GDP because it actually talking about economic transactions, not really how it affect Australian economy, okay, but the transaction between economies as mentioned. Okay, now again, if our currency were to appreciate, then it will be expensive for foreign investors to invest in our country. Okay, you wouldn't want to invest in the country where when the currency of that country it's on the rise, because it's not worth it, it's expensive. Okay, you will invest when the currency is not too strong. Okay, so if the currency value is too high, you may not want to, so it's expensive. Then of course our capital inflow, which means foreign investment inflow, will be lower. Okay, next, factor number 2, world economic growth. Okay, when we look at world economic growth, every time when we look at that word world economic growth, it actually refers to our trading partners economy. Okay, so if trading partners economic growth rate yeah, were to increase, that means trading partners economy expands. Okay, in that case, what will happen is trading partners national income will be on the rise. If you refer back to video 1, the previous video, you would understand what I'm talking about here. So trading partners national income would increase, then their purchasing power will increase. Your trading partners, yeah, trading partners purchasing power will actually increase. In that case, they will demand more of Australian exports. Okay, let me put it this way, more of Australian export. Okay, so when they demand more of Australian export, of course our export revenue would increase. So that improves economic transactions between Australia and the trading partners. Okay, besides, if our trading partners economy were to expand, they have more income, they will have more funds available to invest in their country or invest abroad. So if they were to invest abroad, they may choose Australia if we have free trade agreement with them. Okay, because that will make it easier to invest in Australia. Okay, and therefore in Australian case, we will get more capital inflow. Okay, now again, you don't have to stop at GDP, you can just stop at capital flow because we are talking about economic transactions. Next, we are looking at factors number 3, domestic economy growth. Okay, every time you see the word domestic economy, it actually refers to Australian economy. Okay, so if Australian economy were to expand, that means Australian economy growth rate were to increase, then now we are looking at Australian purchasing power would increase. When Australian purchasing power increases, we will buy more import. Okay, so demand for import increases, import spend will increase. Okay, now next, if Australian economy were to expand, we as Australian, we may not only buy more imported goods, we would also buy more local products. Okay, so if we were to buy more local products, then demand for domestic goods would increase. To buy more Australian products, spend within the economy. So in that case, it will actually result in higher pressure on price. Okay, because higher demand, higher price. Okay, then it will push inflation rate upwards. Okay, in that case, of course, it will cause our export price to increase. Okay, export price index will increase. When export price increases, demand for export would fall. Okay, now for foreign investment, okay, when Australian economy expands, it will attract foreign investors to come in. Okay, in that case, when you attract more foreign investors to come in itself, that actually contributes to capital inflow. Okay, it may increase, and of course, return on investment. I've mentioned this in the first slide. return on investment will increase because we would have to pay more. Okay, when we have higher foreign investment. For example, if foreign investors comes in buying shares, okay, buying local company shares, okay, in that case, when the company is making money, dividend has to be paid out to shareholders. That is a form of return on investment. Okay. Next factor is relative inflation rate. Okay, for relative inflation rate, we are actually comparing Australian inflation rate with the rest of the world. Okay, so if Australian inflation rate were to be higher, okay, or lower, it will affect the transaction between the countries. Okay, so in this case, let's assume Australian inflation rate is lower. When our inflation rate is lower, it will actually mean, okay, it actually mean the price of our goods and services, yeah, would increase at slower rate. Price will still increase when your inflation rate is positive, okay, but it will increase at slower rate here. Over time, when your price were to increase at slower rate, over time, you will realize that at some point your price may be cheaper. Your price is cheaper, demand for export will increase, you will gain more export revenue. Okay, and on top of that, if our price were to increase at slower rate, our product becomes cheaper over time, then demand for import would be lower because we would spend on local product as it is cheaper instead of buying imported goods. Okay. Next factor, relative interest rate. This one we are looking at Australians' interest rate compared to another country. Okay. Now, if Australian interest rate, for example, yeah, is lower. Okay, if Australian interest rate here, I put here, is lower, then it would mean cost of borrowing, this is for Australia now, when looking at it, cost of borrowing would be lower. So when cost of borrowing here, when Australian were to borrow money from the bank, okay, to uh, uh, to invest, okay, to start a business, to expand business, okay, businesses, Australian businesses borrow money from bank to expand business. Now the interest rate is lower, then of course our cost of borrowing will be lower. Okay, when cost of borrowing is lower, when you translate it into our cost of production, because whatever we spend in a company, it will be reflected in our price, right? It will become our cost of running the business, so it will be reflected in price. So see, when our cost of production is lower, we can actually try to reduce our price or keep our price lower or maintain the price, if not, if not lowering down, at least maintain the price to keep it competitive. So consumers will find it less burdening to buy our products. So in that case, demand for our export would increase, and therefore we will have higher level of export revenue. Okay, and not only that, if our interest rate is lower, then the difference between our interest and the rest of the world would also be lower. It will actually discourage foreign investors to come in. Okay, so in that case, capital inflow would be lower. Okay, now what does that mean? Okay, let's assume Australian interest rate, okay, is, for example, 0.25. Okay, it was, let me just show you the change. It was 0.5%. US was 0.25, for example, yeah, percent. In that case, the difference is 0.25. Am I right? Our interest rate is 0.25 higher than than US. So if that is the case, you will actually see more US investors wanting to invest in Australia. Okay, because it's worth it. You earn more. If you were to put your money in Australian bank, you earn more. If you were to give loan to Australian, you earn more interest. Okay, but if interest rate were to reduce to 0.25, where else US didn't change their interest rate, for example, then there's no difference here. The difference has reduced from 0.25 to 0%. If you are a US investors, would you want to take all the trouble to invest in Australia? You wouldn't. Okay, so that's what we mean by differential in interest rate. Okay, now number 6, productivity and cost efficiency. Okay, when we look at this one, we are looking at if the productivity level of Australian factories, okay, or any factories, any countries, if their productivity level is higher, okay, because they have skilled workers, because they have professionals, because they have the latest technology, okay, so their productivity level is higher, of course, then their efficiency level will be higher. So higher efficiency level will actually tells you wastage will be lowered down because the same time frame, the same resources, you can produce more. Okay, so reduce wastage will reduce cost of production. So if that is the case, yeah, when you divide it out, your unit cost of production surely will be lower. Okay, so you can actually achieve economies of skills. Okay, economies of skills, you actually learn it in year 11. All right, so if not, please refer to my later video on what is economies of skills. Okay, but basically the general idea of economies of skills here, it actually means how you are able to average out your cost, okay, your general cost into your cost of running your business into larger amount of output. So each output that you sell, lesser amount of it would go to financing all your cost. That's how you achieve economies of skills. And you can achieve it if you have higher level of productivity, if you apply mass production method. Okay, so if you can achieve economies of skills, your price level will be lower, and therefore your demand for your export will be higher, and it will result in higher export revenue. Okay, next small part, as I've mentioned in the beginning of this video, is the composition of global trade. Composition of global trade, for exam purposes, we only need to know a few things. Okay, number one, we need to know what is the most traded commodities. Crude oil. Number two, we need to know what is the most traded sector. That would be manufacturing. For exam purposes, stick that in your mind. Okay, that's all we need to know when it comes to trade commodities or most traded products lah. Okay, next we may need to know the leaders of trading. Okay, world leading traders. Okay, US is the first, followed by China, Germany. That's it, we need to know 3. The rest no need. Okay, so composition of global trade, that's about it that we need to know. Okay, now next thing, when it comes to, we're going to conclude this subtopic. Okay, so what we have learned is factors. Okay, we have covered 6 factors affecting the global trade, okay, as I've listed out here, and we have also covered the composition of global trade. Okay, most traded commodity, what it is, most traded products by sector, what it is, world leading leaders, which countries. Okay, now as usual, I will actually show you sample questions. Okay, this is a sample of data interpretation question. Okay, where it says, based on the following chart, discuss 3 factors contributing to the pattern of world trade over the years. Okay, 6 marks. Now, in this case, if you look at it here, they give you a chart that shows you from 1981 to 2018, okay, how the world exporting countries has changed. Okay, so 1981 you will see US being the leader. 2008 you will see China and Germany overtook US, and then in year 2018 China overtook US as well. Okay, so in other words, you see the most significant change is China overtaken the other countries when it comes to their role in the as exporting country in the world. Okay, so what are the possible factors? It says discuss possible factors of a rise of China. That's what the question actually wants. So some factors I have put in here. If you can read through on your own, this is actually factors from the 6 factors that we have covered in this video. Okay, then I have another slide here, the last slide, that shows you sample answers, okay, of this particular question. Okay, so you see, so this student actually wrote, based on the chart, there's a change, okay, of what? So the student actually tell the examiner, I have observed some changes here. You need to tell the examiner that. Then I tell you one reason, okay? This whole thing will be 2 marks, yeah? I tell you one reason why there's this change that I've observed. So the reason that this student has put in is the production. Okay, basically the student is trying to talk about the productivity point, that China moving into industrialized and becoming industrialized country, and therefore their productivity level is higher, so their product can be cheaper because they achieve economies of scales. Okay, so that's how you should be answering data interpretation question. When you get the data, tell the examiner what you see in the data, then answer the questions. Okay, so I hope this video helps you to understand topic 1.2, pattern of world trade. In the next video, we will cover topic 1.3, the international competitiveness. See you in the next video. Bye.